Hey guys, hope you guys can hear me. Just doing a quick check. I got to get better at this whole swapping before the start of the show. I'm still getting used to these controls over here, so I apologize if you didn't hear me a second ago. Just getting set up here. We got a lot to cover today. There's going to be not only the market news, but I'm going to be showing you guys my portfolio buys. All right, because I did make some buys, and I think they're going to be for the better. You guys are going to see this, like I said, live in action. So we're going to go ahead and get through all of that. I'm going to give you guys my thesis of why I bought these particular holdings. And these are high dividend yield payers. So I'm actually really excited. I was like a little kid last night. Couldn't go to sleep. Right after I made the purchases, I was just looking at the charts, and then, I had to force myself to go to sleep. But yeah, these were some very large purchases. So really excited to get into this, the market news, and there wasn't a whole lot that happened yesterday. So again, we're just going to breeze through this stuff, and then we'll get to the portfolio stuff. All right, so let's get it started, guys. Okay. Let me make sure everything is set up here before we get started. I don't want another mistake like yesterday where I was talking and nobody could hear me. Okay. Let's get into it, guys. So this is the portfolio today. This is what it looks like, right? I have actually two different portfolios now. I have a cover call ETF high dividend yield portfolio, and then I have my core portfolio, which you guys have seen before. It primarily makes up the REITs. Has VGT in there, a tech ETF, and it has a little bit of BDCs in there and some a crypto ETF, right? I was planning on using M1 Finance to have basically all of my holdings consolidated, but the problem with M1 Finance, and it's not, I don't know, I still really like M1 Finance, but the bigger problem with M1 Finance is that they don't have all of the funds like some of these other brokerages do. When I was trying to request like curve funds, they wouldn't add them. And, there's also new funds that come out and they won't add them because the trading volume is so low, or for one reason or another, they won't add them. So that was kind of a kick in the butt. But again, it wasn't, anything like, it's not a deal breaker. Again, M1 Finance is built for, very long-term investment focused type of investors. It's not built for trading, right? It's not built for trading. You only get 2 trade windows a day, in the morning and again in the evening. So, it is what it is. So instead I had to move my cover call ETF. I call it the cover call ETF stack, or I think, that's where I pulled it from, was from Oracle ETFs, which I'll show you guys here towards the end of the video. But I believe, where was I going with this? Oh yeah. So I had to move some of that money off of M1 Finance and move it into another brokerage. So I ended up going with Robinhood. Robinhood, I have, a little bit of mistrust with, but you just can't beat the utility that Robinhood offers. And, it is a great platform. It is like really a great platform. I think it just lost a lot of face and a lot of trust. But again, you still can't beat the utility of it. So I decided to move my cover call ETF portfolio to Robinhood, and that is why I have 2 portfolios now. And now my portfolio, actually total portfolio, is generating $32,000 a year. Okay. Now, before I even get into all that other stuff, I got to caveat this. I'm not a financial planner, advisor, etc. Those are people you should talk to. Do not follow me. Do not copy my trades. Nothing like that. All right. I'm just telling you what I'm doing. So even though this number is really high and it's really kind of attractive, you still got to be very careful with it, because this number can fluctuate. It could go up, it could go down. So you got to kind of take this with a grain of salt, right? This is annualized income based on current projections, right? And dividends, they can get reduced, they can get cut, they can get suspended. A lot of things can happen with dividends, so you got to be very careful. All right. So, what's up, Shannon? Yeah, I was very surprised that the markets didn't go red after that fight in the White House. That was wild. Anyways, guys, we're gonna move past that. We're gonna get into it. James, what's up, man? Welcome back. Happy Friday, guys. Thanks for joining me. But yeah, this is the portfolio today. Again, like I said, I have 2 different portfolios now, and I'm gonna be getting into this after the video. Okay. All right. So let's get into the news, and then we'll get into the portfolio stuff. So some news broke yesterday or today, your guys' time, Eastern Standard. Inflation growth may be in conflict with the Fed, or maybe in conflict, but Fed seeing restarting cuts in June. Okay. So we were kind of already thinking that, it's going to be the second half of the year before the Fed starts cutting again. That was kind of the prediction by the market. And that was kind of the prediction that I was following as well. I was thinking it was probably going to be a little after June because, again, we have tariffs, we have all this geopolitical stuff that's happening, we have all this, potential trade wars, and then as we just mentioned in the chat, we also have the war, the conflict in Ukraine and Russia. So again, everything's up in the air right now. It always is when it comes to this administration, which obviously riles the markets. And this week was one hell of a week. All right. It was one hell of a week. It was a very bloody week. Like I said, I dropped a lot of money into VGT, which is a tech focused ETF. And then it went red. I was down almost pretty much almost $12,000 in the first week, right? Not a good start. And it kind of makes you clench up a bit. You're like, damn, I wish I waited, but hey, it is what it is. And again, over the span of 5, 10, 15, 20 years, what is a little blip like this, right? I probably won't even remember it. Well, I will remember this because it was kind of funny, but anyways, I digress. Let's get into the news, guys. So inflation growth may be in conflict, but the Fed is seeing restarting cuts in June. I found there was something really interesting in this article. New data may point to emerging tensions between the U.S. Federal Reserve's dual inflation employment goals as price pressures remain sticky in January while consumer spending is slowed more than expected. Okay, that means basically inflation is really, really sticky. Traders maintained bets that the Fed will cut interest rates by 1/4 percentage point at its June and September meetings of this year, but analysts noted the situation seemed to have become more complex and could present policymakers with a difficult decision in the weeks ahead. Hence, this is the part that I found really interesting. Hints of slowing growth alongside inflation still stuck above the Fed's 2% goal, right? Presents a dilemma for the Fed. If you add them together, that equals stagflation, guys. We talked about stagflation on this channel. We talked about having an equal weighted index as part of the portfolio, or maybe investors might want to think about that. We also talked about, in a flat market, covered or dividend paying companies, dividend paying ETFs are going to be all the rage because, they'll still be able to make money in a flat market. Said Peter Cardillo, chief market economist for Spartan Capital Securities in New York, the Fed now has a lot of worrying to do. Stagflation refers to the combination of slow growth and high inflation that forces policymakers to potentially choose between cutting rates by more at the margin to support economic growth and jobs, or maintaining tighter monetary policy to ensure inflation returns to target. I think we covered this on this channel. I think we're moving into this whole new normalization period where it's just going to be normal. Like we're just going to adapt to this new higher elevated level of inflation. I don't know if we'll get to 2%. I don't think. Well, I guess historically they've always said we've been at 2%, but I really don't think, we've always been at 2%. I think we've always hovered around 2.2%. But again, who am I? I'm just a peon in the system. But anyways, with that being said, it's going to be interesting how the rest of this year plays out. Will this year trade sideways is a good question, right? Will this year trade sideways? We mentioned on another episode that, what if the Magnificent Seven are not what they crack up to be, right? What if they're actually slowing down themselves? Because the Magnificent Seven have been driving the market, the S&P 500 growth, the new highs almost every other day, every other week, right? But what if they're actually starting to slow down themselves? I mean, you have companies that are just doing really crazy things, going left, going right. You have Netflix that's thinking about adding content creator podcasts to their platform, right? As a jab at YouTube. You have Google, you have Microsoft, and you have Apple. No, Google, Microsoft, and was it NVIDIA? I don't know. It was one of the other big tech companies. But they have like quantum chips now, right? They're coming out with quantum chips. They're making their own hardware. You have Tesla that is in the car market, but they're also making robots, and they're also, developing AI. All these companies are developing AI of some sort. Like it's really getting crazy. They have to continuously innovate. They have to continuously find new ways to make money. And I think like in Apple's case, they're so big that they can't make anything new. Like they really can't make anything new. Their Vision Pro, those $3,000 goggles, those things flopped really quick. They spent a lot of money in the research and development of these Vision Pros only for them to flop it, right? Just basically get rid of the whole project altogether. And I think it's because they see the writing on the wall. It's like, one, nobody was going to buy $3,000 goggles. That's for sure. But it's getting harder to innovate. Like they're competing with Meta, right? They're competing with Meta. They're competing with all these other makers that are making these VR goggles. So I think they saw the writing on the wall that that's just not what they should be doing. Instead, now they're going to be putting $500 billion into, AI factories, training, research, development. And I suspect that they're looking for a return of some sort. They're not just doing it out of the goodness of their heart. When companies usually get way too big, what they have to do is end up either doing mergers and acquisitions, acquiring smaller companies and adding them into their registry, right? Adding them into their business so that they can maintain their edge. Or they make investments into whatever projects and then get a return that way. That way shareholders can, basically get that same kind of return on investment. So, you see this in the real estate market. Some of the bigger REITs, they'll acquire smaller REITs because they can't grow any bigger, right? They can't, like, let's see, Realty Income is a good example of this. They're a triple net lease REIT. They buy basically retail buildings, put tenants in them, collect rent, but they got so big that growth was muted. Like they were not growing anymore. So instead what they started doing was acquiring other businesses, and they started venturing off into really other different parts of real estate. They started going into gaming and casinos. They have a stake in some properties, I think like MGM or Vici or whatever. They have some stakes there because, they can't grow anymore. It's hard to buy portfolios of buildings now, right? For a company like Realty Income. And now they're breaching into the European markets, right? Like it's just getting harder for them to grow, and investors want to see constant growth, right? That's why they put their money there. So I think in like Apple's case or these Magnificent Seven, they're going to reach that point where they're too large and they're going to have to start acquiring smaller companies, or they're going to just start investing their money in all these different projects in order to get a return on investment. So anyways, I know I went off in a huge tangent, but I apologize for that, but I forgot what I was going with this point. Anyways, stagflation. That's what I was worried about. Yes, stagflation, right? There might be some story to all of this that makes sense that we could be heading into a period of stagflation. I don't want to base the whole idea of stagflation off of one bloody week, but I'm just saying like maybe this year does trade flat. What if we trade flat for the next 2 years, right? How could you position yourself? How could you position your portfolio? And that's going to lead a little bit later into my portfolio reveal when I talk about, the high yield income ETFs that I just purchased. Anyways, moving on. Policymakers began pointing to the possibility this week the Fed could have to balance inflation risks against growth concerns. Kansas City Fed President Jeffrey Schmidt said in comments this week that noted what he felt were upside risks to inflation and concerns that uncertainty about the economic outlook could begin to weigh on growth. These are risks that could make our monetary policy decisions increasingly difficult. All right. Schmidt, I believe, is the president of, the president of Kansas City Fed Reserve. So there you have it. One of the presidents of the Federal Reserve is saying this, and there's a couple of them. I forget how many specifically, but each there's like regions, and each region has a president, and then they work in conjunction with Powell or Jerome Powell, and they make up the Fed, right? The FOMC. I forget what it's called. Anyways, we'll move on. Got to get that coffee in, guys. Whew, last night I could not sleep. Okay, extreme fear. We went up 2 points. Okay, we were 18 yesterday, right before I went to bed, and then now today we're at 20. So we're looking good. All right, we're heading back into just normal fear. There was a lot that happened yesterday, which is kind of crazy. You had the whole, President Trump meeting with President Zelensky, and that didn't turn out well. I was surprised that didn't just completely make the markets go down. I was very surprised by that. The whole inflation data coming in, again, I think that's, I'm surprised that also didn't cause the markets to go down. So I don't know why the markets went up. Nobody really truly does, but it was nice to see that the markets are at least recovering for the end of the week. I think, again, and I said this in yesterday's stream, March 4th, between Monday and March 4th, March, was it 1st or something? What's the calendar? So March 3rd and March 4th, I think these are going to be the 2 days that really are going to determine and set the tone for the rest of the month, right? Because it's the talk of the whole tariff thing, right? Are we going to tariff Canada and Mexico? Trump's been saying that he's going to just start implementing these tariffs on March 4th. So is that going to happen? So I did just a little bit of research into this. I don't have the articles right now, but just real quick, because I don't want to go into it too deep. Basically, Canada already had a bunch of people working the border, and they gave them more drone technology to monitor the border. And there's only been like 24 kilos worth of fentanyl that came from Canada versus which is like a small like 0.04% of the total amount of fentanyl that's hit the United States versus Mexico's 99 point whatever. But Mexico actually has already deployed troops to the border, and they've been, kind of policing the area. But there's, a lot of doubt whether that's going to help or not, because the cartels are so kind of entrenched with the government. But Mexico definitely doesn't want to get tariffs put on them. So they already complied, and they already have soldiers working the border. Whereas Canada, they just kind of gave more drones to their border police, right? I think they're called Mounties or something. If anyone's from Canada, please correct me, all right? But yes, that's already happened. So this is why I think the tariff thing is kind of just going to die. It's the markets are going to recover, in my opinion. The markets are going to recover definitely by Monday, if not by March 4th, is my prediction, okay? But we'll see, because Trump is crazy. He likes to flip flop a lot. He likes to reverse at the last minute. So we will see. Anyways, all right, let's move on. So S&P 500, we had a bloody week, right? It's just horrible week. And it looks like it finally recovered, or it looks like it's starting to recover. So that was a welcome sign. We're up 1.6%. And for the NASDAQ 100, the tech heavy NASDAQ 100, looks like they recover 1.62%. Again, a welcome sign, definitely, because over the last 5 days, it was just trending downwards. How's our buddy in Bitcoin land doing? They had quite the interesting week. All right. They dropped from all-time highs, right? Not too long ago, February 1st, and they've just been on a steady decline, right? So it was nice to see that, they dropped as low as $78,000. They dropped as low as $78,000. That is scary, right? That is really scary. I hope whoever is watching the stream, if you were able to take advantage of some of these prices, you got in. I know there's a lot of diehard crypto people out there that might say now's not a good time to buy, or, we're heading into crypto winter, or this or that. I don't know anything about crypto seasons, okay? Fall, winter, summer. I don't know anything about them. Bull runs, bear runs. I don't really keep up with that. I just look at the chart, okay? I just buy whenever I think there's an opportunity. So I think there was an opportunity right here. Can it go lower? I was basing this. I had a feeling based on another YouTube video from Dividend Nomad, and he was the one that actually said that he had a lot of friends that were tied into the crypto space, actually trading this and that, and they saw that there was a lot of orders put in for 80,000. So I mean, take it for what it is. You know, it's kind of like anecdotal information, you know, secondhand information, even third-party information. You wouldn't base a whole investment thesis around that, but it's just an interesting data point. And sure as hell, it dropped to 80 and as low as 78, right? And then people started buying in like crazy. So is this going to go back up? I don't know. But I kind of think there might be a little more pain for Bitcoin ahead, especially next week. I'm not basing that on anything. Again, I keep seeing the number 75, so we'll see what happens. All right, we'll see if this continues to drop. But yeah, anyways, let's move on. 10-year treasury, as you guys know, we use this as a weather gauge to kind of just gauge how mortgage rates are doing and how the real estate market is going to respond to this. And again, it is doing well. It is on a downward trend, which is what we want to see. Right now, it's sitting at 4.2%. Which is welcome because it was, you know, over the last couple of months, it was just elevated, especially during the December timeframe. That's when, you know, REITs really started to crash and take a nosedive. So right now it looks like it's trending downward in the right direction, which of course is a welcome sign, a very welcome sign. So V&Q, real estate index ETF, did very well. They're up in the green at 0.85%. And I knew I was missing one. I was missing gold. Like I said, guys, I didn't sleep very well last night. Let's see. Gold ETF chart. There we go. Let's see how they did. So it looks like some investors actually pulled their money out, which is weird because I don't know why this chart, it shows that they're actually in the green, but I think it's because this is post-market. So maybe this is, I don't know. But yeah, you know, like over the last 5 days, wow, it looks like it's been trending down, which is kind of crazy because over the last year to date, it looks like more investors are putting their money in. But maybe the fear is over now. Again, using this as kind of like our weather gauge, our investor sentiment gauge. You know, it looks like investors were taking their money out and piling into these other asset classes where they saw, you know, huge opportunities. So that's good to see, you know. So maybe Monday we will see a green day. I think Monday we definitely see a green day, which is a welcome sign. All right, guys. So we're at minute 22. Just going to check the comments real quick. So Shannon says, I didn't put any money in today, waiting on next week. Awesome. So I dumped a lot of money yesterday, and I have a lot more money to dump on Monday. So we're going to wait and see how I got to wait for the cash to clear. But I made 2 purchases. So I'm going to show you guys the purchases because I don't know why, but here it shows only 50. It only shows 58,000 when in reality it's supposed to show about 100. And I think it's because they know like I have margin. But if you guys look at this, annual net income, $22,000. Dividend yield of 22%. Okay. So let me just show you guys the buys real quick to show you guys I'm not, you know, full of it. But yes, this is Robinhood. Okay. I moved to Robinhood, moved this portfolio to Robinhood because I wanted more options to be able to buy these ETFs. So yesterday, I don't even know how to use this platform. Let's see, notifications. Okay. This looks like a good notification. Okay, cha-ching, your first monthly interest payment. No, that's not what I wanted. Your order is complete. 905 shares of XPay. All right, 905 shares of Roundhill's XPay. And then I bought 1,036 shares of XDTE. All right, I put $50,000 in. All right, $50,000 into each of these freaking ETFs. Thank you, guys. All right. So I don't know why it's not showing it, but I am taking margin. All right, guys. I want you guys to understand this. I am taking margin. I'm going to be coming out with a video on margin very shortly. Again, I got to film a lot of stuff. I haven't filmed or uploaded a video to YouTube. I've just been really doing the lives, but you know, over these last couple of weeks, I've been really like diving into the whole high income yield stuff and margin using and blah, 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 blah. And, you know, I really want to get these videos out so you guys can go through it yourselves. But yeah, I am taking margin, and it's a lot of margin. Okay. Really, it's $100,000 altogether. And I have another 100,000 coming in on Monday. All right. And I'm going to be buying even more. I'm going to be buying even more XPay, XDTE, and probably some other items. I haven't quite figured out what the other ones are. And I'm showing you guys exactly what I'm following here. Okay. This is the idea. Okay. This is the idea. I've shown this chart before on these lives. Sorry if I can't, let me see if I can minimize my head here. Okay, cool. So this is the plan that I'm following here. All right. You know what? Let me resize that. There we go. I'm doing this live. We'll do it live, boys. There we go. Boom. Okay. So I want you guys to be able to see this. Okay. So I'm following what is called the cover call ETF stack. I don't even know if that's really a term, or if I made that up, or if I've seen that somewhere. I think I honestly seen that somewhere, but I don't know where. But anyways, it's called the cover call ETF stack. And I am following this strategy as much as possible. I got this idea from Oracle ETFs. Again, guys need to check out his YouTube channel for exactly the strategy that I am following. Okay. But essentially, I already started it. This is what's going to make up the base, right? The foundation. These two tickers, XPay and XDT, are going to make up these, right? Of course, I already have kind of it all laid out here. Take these numbers as like fictitious numbers. These are not real numbers. I pulled these from yieldmax. These could already be wrong for all I know. But, I'm also going to add some medium risk premium yield ETFs into this portfolio. I might, because these are single stock exposed ETFs. And when you invest in single stock ETFs or single stock exposed cover call ETFs, your risk is going higher, right? Because now you're at the whim of the market, and you're no longer investing in something like an S&P 500, which XPay and XDTE actually are, right? They have their cover calls or their calls against the S&P 500, right? When you do it with a single stock, imagine something like Palantir that had a massive drop. It had a double whammy in the same exact day. It had, what was his name? The CEO, Alex Karp. He announced that he was changing his plans to sell his shares, and then the government cuts also came in at the same day, and Palantir's share price dropped like a ton of bricks, right? So if you were investing into something like yieldmax's plty, you would have gotten slammed, right? You would have gotten slammed. But if you're investing in something like XPay or XDTE, you're pretty much at the mercy of the S&P 500. And as we saw over this last week, the S&P 500 only dropped, I think like under 5%, versus Palantir's like 30%, 40% or something like that. Just crazy, right? Like whoever's in those plays, man, they got my respect. But yeah, it was not something I want to be exposed to at this moment. But that is basically what's going to make up these last two blocks if I decide to go those routes, right? The option income strategy ETFs, those are going to be your momentum players like Palantir, plty. These are going to be single stock exposed ETFs, but maybe they might be a little higher on the risk scale because, again, they are still single stock exposed. So I was planning to go with curve ETFs. But, that may change. Again, do not copy me. Do not follow me. I'm just showing you guys what I'm doing. So anyways, with that out of the way, that is the strategy that I'm following. And these were my buys, right? XPay, XDTE. And I bought them low enough that the market started recovering. So I'm up a little bit, which I'm, actually kind of proud of myself about. But beside the point. All right. So now that you guys see that, let's see what else we got. So you guys see the portfolio. You guys got to see the numbers, the real numbers, and you guys get to see this. So I'm hoping to drop more money in on Monday, which is going to obviously increase this annual net income, which would be awesome because that's, this is what's going to make up this. I don't want to put my whole portfolio into income like cover call ETFs because I don't know. Me as an investor, I am a little risk averse. I do like the idea of full market exposure. And I am really heavy into real estate. So it was nice to kind of diversify away from real estate and get into tech while tech is having, a bloody week. But still, even if you were to compare tech, right, we'll use VGT as our as our thing here. Even so, like they're still doing pretty well overall for the year. They're still up, you know, for a year, not year to date. All right. But over 5 years, I mean, the graph starts to look a little different, right? Over 1 year, not, you know, not as much as it could be, but again, we'll see. Will it break, you know, the 650 route? I don't know. It can even trend downward even more, which would be kind of wild. If that was to happen, who knows? I don't know. Maybe I'd even sell out of VGT and just move all the money into cover call. I don't know. Don't follow me. I'm just talking out of my butt. Anyways, so what are the two ETFs? Okay, the first one I'm going to cover is going to be XPay. But real quick, guys, I'm not an expert on this stuff. Okay, I spend a lot of time reading and watching YouTube videos just like you. I'm not an expert on any of this stuff. Okay, this stuff is still fairly new to me. Like I understand the concept of cover calls. I understand how the trades are done. I've never done a cover call trade myself. So a lot of this stuff is a steep learning curve. You know, when you really get into the technicals, you know, the actual like how it works under the hood, synthetic calls versus, you know, a stock exposure versus underliers versus, you know, 0 DTE versus long cover calls, like all are out of the money, in the money, like all this stuff is like rocket science to me. And I'm still working through stuff. I'm still learning a lot of stuff, you know, just for background information, because even though there's hundreds and hundreds and hundreds of freaking cover call ETFs at this point, they don't all work the same. Okay. They don't all work the same, which is very important to understand. And I want to show you guys a quick example of this. Let me see if I can find it real fast. Okay, I can't find it real fast. So let's look at XDTE real quick before I dive into this stuff. So if you look at XDTE, max, right? This is since inception date. It started in March at a price of $51, right? $52, let's call it, right? It's only down after a full year. It's only down 6.83%, but it's paid out a distribution rate of 26%. Okay, think about that for a moment. It's paid out 26% and it's only down 6%, and it's only because of what's been happening in the market recently, right? This is really stable in my opinion. This is really attractive to have an asset that fluctuates just a little bit up or down, you know, and you're able to collect a high amount of distributions. When these drop, when you see these massive drops, for me, it's going to be anything under probably like $50, $52 or $51 really. I'm going to just buy it. I'm not going to even think about it. I'm just going to buy it. And then whenever we have these recoveries, like you see here, that's probably when I'm going to sell these shares and then just wait for a better entry point, right? And again, I didn't learn this, but it's called profit ripping, and I learned this strategy again through Oracle ETF. You guys should check that out. But yes, you can core compound these, right? You can profit rip, take off some of the top, wait for an opportunity, buy back in, and then, you know, again, just keep doing that. You're going to increase the share count of this, right? Of something like XDTE. You're going to increase the share count, which is obviously going to give you more money. All right. So this is the whole point of me getting into the S&P 500, XPay, and XDTE. All right. So just again, I'm not going to go in, like I said, I'm not going to go into the comparisons of the two, not in the stream, probably not even a video of it, because I don't think I do a good job of it. But I do want to leave you guys off with a good video that does cover it. And that's from the man himself, Oracle High Yield ETFs. Okay, this video will be down in the description for you guys, so you guys can look at it yourself. But he compares both of them side by side and explains, you know, like, you know, their historical returns, how much money they've given, etc., all that good stuff. A lot of YouTubers, and I don't want this stream to turn into one of those, but a lot of YouTubers were downplaying XDTE, calling it trash in favor of yieldmax, in favor of Defiance, in favor of other, you know, funds out there. I'm a huge believer in Roundhill. I'm a huge fan of Roundhill now. I'm a huge fan of Kurv. I'm gonna go with Roundhill over the other ones. No history of reverse splits that I found. No history of screwing over, you know, the investors. I think they just got their stuff together. Okay. Yes, they do, what's called the ETF in a box. So they outsource their trading, but it seems their outsourced trading is doing freaking well. So I don't care if it's outsourced. I don't care if it's in-house. I just care about my return, right? Me as the investor. Am I getting my money, or are you eroding my money through the NAV, right? So this fund doesn't seem to do that at all. Again, you guys should definitely check out that video. All right, with that out of the way, okay, let's take a look at these two. I've covered these on the channel, I think before, maybe in a stream, but we'll just take a look real quick. So the Roundhill S&P 500 Target 20 Managed Distribution ETF XPay is designed to pay monthly returns of capital distribution to shareholders at an annualized rate of 20% while providing exposure to the S&P 500. XPay is an actively managed fund, so this distribution rate is at 20%. This so far has done its job, okay, and it's still fairly new. It only came out in November, so there's not that much track record for it, but it has maintained a really good. I don't know why it doesn't show. Yeah, I don't know why. But it has maintained its dividend, right? It has maintained it, which is really, really cool. So again, they've been paying out almost the same amount of money the entire time, right? So I'm going to put my money in here. It looks like it did drop a little bit here to 95, but I don't know. That doesn't really worry me too much because again, I'm going to monitor this over the next 12 months. They do have a massive disclaimer here at the very top, which if you're looking at this ETF, you need to read, okay? You need to read this and understand this, all right? But why XPay? Monthly distributions. XPay seeks to offer monthly distribution payments to shareholders at a rate of 20% annualized. This is a very tax efficient ETF. XPay seeks to target 100% return of capital. So let's talk about return of capital real quick, especially for dividend income investors. Return of capital is attractive, right? Because you're not going to get taxed on it like you would with ordinary dividend income, right? Which is taxed at your nominal rate, which REITs, typically pay out in because it's rental income, or you get a qualified dividend income, right? Qualified dividend income, you get better tax rates and things like that. For ROC, because it's your money, you're literally giving Roundhill your money, and they're giving you some of that money back, right? That is not taxed. However, what it does is lower your cost basis. Okay, it lowers the cost basis of your shares. So let me see if I can see it in Robinhood. I don't know. Like, I'm still learning Robinhood's freaking platform, so excuse me, guys. Let's see, cost basis. Okay, I don't see cost basis in here. Let's see, maybe here. Okay, maybe this we can work with this, right? So you will have like 905 shares, right, at a $55.40, right? So my cost basis right now is $55.40. When they pay out that dividend, or that return of capital, this will drop, right? The cost basis will drop. Theoretically, it can go to zero, right? You can own all 905 shares for $0, right? No idea what the share price would be, but let's just pretend it's in a perfect world. All right, so let's say you have 905 shares at $0. After that, any dividend that you collect will be taxed as capital gains. So that is one thing a lot of investors don't fully understand or comprehend or even talk about in the YouTube space. So I'm just sharing that with you guys. I'm not a tax professional or anything like that, but I think that is something to at least be aware of, because all these YouTubers are like, oh, yieldmax, 100% distribution rates, we make so much money, everything's great, all these cover call ETFs, they provide so much money, it's all return of capital. Well, if your shares go to zero, right, hypothetically, in theory they could, if your cost basis goes to zero, you would have to start paying taxes on those on those dividends. And not only that, but if you were to sell your shares and you have a cost basis of zero, and let's say you have the 905 shares and overall is $50,000, right? Let's just pretend. Well, you're going to get taxed on $50,000, right? If you sell out of all those shares. Okay. Again, I'm not a tax person. Talk to your tax advisor, etc. But that is the way I understand it. If you have a difference of understanding, please put it in the comments. Let me know. But that is exactly what I read about and what I got. Right. So, interesting to say the least, right? Total return potential. XPay's secondary investment objective is to provide exposure to the return index composed of U.S. listed large cap equity securities. All right, we're gonna skip all this. All right, the whole expense ratio. I mean, I was always against high expense ratios. Again, coming from an old school type of investor, fire movement type of investor, maybe the Dave Ramsey's way of looking at stuff. I'm looking at expense ratios as nothing more than as a cost of business, right? As a cost of me putting my money in there. Fund managers need to make, they need to keep the lights on. They need to feed their families. So the expense ratio, that's what it is, right? That's what it is. I'm perfectly fine with higher expense ratios as long as they make good on their promise to provide me a good return. Okay. Excuse me. So these are what they have in their holdings. Again, they're doing it against SPY, which is a S&P 500 ETF. So they're doing they're basically long cover calls against SPY, right? You can see 2026, you can see 2026, some for November of 25. These are way out there, okay? Way out there. And then that's pretty much it. Distribution 19, they're going to be paying it monthly. So that's about it for XPay. I like XPay because, again, it should hold up well. And it looks like it did hold up well over this, small little bloodbath that we had. Okay. It looks like it did hold up very well. Yes, it went down. But again, when we compare that with the S&P 500, I like that. Like it tracks the S&P 500 very well. Right. And it's going to be paying out a 20% dividend yield. So, again, when you look at it in that light, yes, you're not going to get the growth because they're paying out so much money. You're not going to get the growth. These are not growth funds. All right. Let's get that clear right now. These are not going to grow with the S&P 500. What they will do is maintain stability. All right. They will be around the $50 to $55 price, which you bought it at, right? This started at $57 and over that period of time, it's only dropped 2.5%, but it paid out 20%, right? It's paying out 20% when annualized, of course, right? But all that money that they paid out, this fund realistically should be a lot more lower, but it's not, right? Again, that video that I recommended, Oracle ETFs comparison, he goes into a little more in depth into that stuff, so you guys can watch that video and get a better understanding of it. But this is why I chose to go with XPay, right? I like it. I want that stability in the portfolio. I don't want NAV eroding garbage. And I always pick on this one, but I'm going to pick on tsly again because I thought about putting money into this at one point. You're right. And I'm glad I never did. But look at this, right? You don't want this. Yes, they're paying out high amounts of distribution, but your money, your principal capital is going in the trash, right? Imagine giving yieldmax $10,000 or $50,000. Imagine them giving you $50,000 and they gave you $48,000 back, right? They gave you $48,000 back for the year and your capital completely eroded, right? People are like, oh, well, anything after that, like, because I think this distribution rate's only like 50%. Let me get into it. Oh, it's 80% now. Well, at one point it wasn't 80%, but imagine if they gave you, let's call it 50%, right? Let's call it 50%. Imagine they gave you that. It's going to take you 2 years to get your money back and before you make any profit. All right. Think about that for a second. All these people, all these YouTubers, which drive me nuts, they're all talking about how great yieldmax is and how much money they're making and all this other stuff. They don't really understand that under the hood, they're just getting paid their money back. And it's going to take them a year or two to actually break even, right, on every dollar invested and reinvested and every dollar put into these funds. It's going to take them a year plus to get their money back before they see any return, right? And depending on how that dividend is paid out and how it's classified, they could be paying tax on it. Imagine paying tax on money that you handed to yieldmax, they handed it back to you, and now you got a tax bill for that. That is beyond wild to me, guys. That's like going to an ATM, putting in $100, walking away 5 minutes, coming back, asking for that same $100, but now you have a $100 tax bill attached to that, right? It's just freaking wild to me. Anyways, let me get off my high horse. So XDTE, we'll cover this real fast, all right? XDTE utilizes a synthetic cover call strategy that seeks to provide current income on a weekly basis, weekly over the monthly, right? These new weeklies are making waves. They're all pretty much all the rage now. But yes, there's a synthetic cover call strategy that seeks to provide current income on a weekly basis while also providing exposure to the price return of the S&P 500 index. Again, you're exposed to the S&P 500 of the largest US based companies. I feel pretty safe there, right? It's not single stock exposure. So the Roundhill S&P 500 0DTE cover call strategy ETF XDTE is the first ETF to utilize 0-day to expiry 0DTE options on the S&P 500. XDTE seeks to provide overnight exposure to the S&P 500 and generate income each morning by selling out of the money 0DTE calls on the index. All right, here's an interesting thing. So yes, I already see it in the comments from Shannon. 95 basis points. Hell yeah. For an expense ratio. Yes, it is a very, very expensive ETF, right? I think, yeah, I think it's 95%. Is it? Let's double check. Where is it? I know it's up here somewhere. Expense. Yes. But again, I'm looking at this as a cost of doing business. All right. You have to make that decision yourself, whether it's worth it or not. I know there's those calculators out there that, compounded over time, over long periods of time, this can cost you hundreds and thousands of dollars. Yes, I fully agree and understand exactly where you're coming from. When you start investing in these cover call ETFs, you really got to throw away a lot of the old paradigms, right? The old mindsets, the old kind of the Dave Ramsey stuff, right? The Dave Ramsey stuff, the fire movement stuff. Like, there is a time and place for that stuff. For me, as an investor that's getting better at being an investor, right? That wants to focus on income, I have to throw some of those old paradigms away, right? It's not easy. Like, I still believe in diversification, right? But, you look at some of these big managers, these hedge funds, these, the Warren Buffetts of the world, not Jamie Dimon, Bill Ackmans, all those, freaking legendary investors. You look at them, you think they're investing in freaking ETFs? No, they're investing in like a couple concentrated positions, right? They're investing in a couple concentrated positions, and they ride it out, right? That's how they make their money. They have a thesis behind each of the companies, each of the picks, and then they go for it, right? So I forgot where I was going with this, but yeah, the expense ratio for me is like, it's not it doesn't really bother me much, especially when you start moving into this type of investing. But I totally understand exactly where you're coming from. Anyways, let me continue on. This will pay weekly distributions. XDT seeks to pay weekly out of the sold option premiums. Income potential. XDT seeks to generate income through a cover call strategy on the S&P 500, and then they want to harness volatility, which we obviously had a lot of. XDT sells 0DTE options on the S&P 500 and seeks to exploit structural market mispricings. Okay, so the expense ratio, which we just covered, let's take a look at their dividends. It does fluctuate. Okay, it does fluctuate quite a bit, which is understandable. But as long as they pay out, that's all I care about. Some months might be a little higher, some months might be a little lower, but overall they usually pay out. And these two big spikes, from what I've heard and what I've been told, Roundhill, what they like to do is hold on to a bunch of cash so the NAV doesn't deplete and go down in value. And what they'll do is they'll make out some massive payments towards the end of the year. So I don't know. I like that. I like Roundhill. Roundhill, thank you for freaking, valuing me as a shareholder, and thank you for not screwing me over, right? And for keeping the NAV constant, all right? So real quick, I just want to show you guys this. I just discovered this today, but you have, and I hate to pick on yieldmax, but I have to pick on yieldmax, man, because there's so many damn YouTubers out there that are basically just brainwashing their audiences. So they came out with their own 0DTE cover call strategy, right? Very same thing to Roundhill. And they're probably using the same exact strategy or algorithm, whatever you want to call it, to make these trades. But if you look at the day, And only time is going to tell, right? Once we have more performance data and to see how much yield max is actually paying out, that's, we have to wait on that. But look at this right now, 45 basis points up. And if we compare that with, I'm going to steal UBTC. If we compare that with XDTE, 96 basis points, right? Double what yield max put out. I'm not saying yield max is bad or anything. I kind of am, but I'm saying, like, look at the difference. Okay. Time's going to tell who's better or which ETF makes more sense for you. I am always going to go with Roundhill at this moment. Could that thesis change in the future? Probably. And if it does, you can bet I'll be selling out of XDTE to get my money out. Yeah. So anyways, guys, covered a lot on this channel. We are at minute 50 here for this stream for the coffee hour. I got to have another sip of coffee. My throat is getting dry. Man, I am telling you, this market is crazy. This whole week was wild. I am really predicting next week we'll see greener days. I think we've had such a bad pullback. As you guys can see, there's a lot of outflows from gold. So that to me could be a good sign that people are, starting to flock to, back into equities, and things like that. So, only time will tell. But anyways, guys, is there any final questions? Anything? How'd you guys like the presentation? Did you guys enjoy the stream? Let me know in the comments or in the chats. All right, guys. Well, I think that's going to do it for me in this stream today. Again, I got another big purchase on Monday. So I'm hoping Monday we'll see a little bit of a pullback. And I'm hoping to get in on some more ETFs. BR Supreme Constitution, I appreciate it, man. Thank you so much. Yeah, gold is still pretty high. Yep, gold is still pretty high. I have some actual physical gold, not me personally, but my significant other does. Bought a lot of gold prior to the run up, so I'm sure that gold is worth it now. And it's like 24 karat gold or something like that. So, let's see. We have Fun Life. Hey man, thumbs up to you. Thank you for joining the stream again, as always. Nerdy Film Girl, thanks for joining. Thank you for giving us hope. Well, thank you for joining the stream again. I think come Monday, the tariff talks and all that stuff is going to go right out the window. It's a prediction. I could be wrong. I'm sure I absolutely probably am. But it's just, I don't know. It's just a thought, because if you look at the news, if you look at Canada, Mexico, they've already done their part of the deal, right? So I don't know what Trump's going on about. The whole China thing and the whole EU thing, that I think, if those come to pass, not on March 4th, but if those, March 4th, I believe China tariff should come to pass. But for the EU, like, that also played a big part in the market taking a dump, because it's like, man, now there's even more FUD, right? There's even more fear, uncertainty, and doubt. And you have the Federal Reserve trying to figure out, like, what the hell is going on? Like, what are we doing here? Like, how can we navigate all this crap? And again, that's just Trump being Trump. Like, that's just his administration. It was like that the first time, and it's going to be like that the second time. We're only 3 months into his administration out of 4 years, right? Out of whatever, how many months that is, 48 months, I think, right? We got a long way to go. And you couple that with a federal layoff of the workforce, or a workforce layoff from the Fed, from the federal government. That's obviously going to have an impact, because that's lending more to unemployment, right? Because now these people need to find jobs. But our deficit is going to come down. Our federal deficit is going to come down, which is a good sign, which is good for the 10-year treasury, because as more of the deficit comes down, the government doesn't have to issue out, or the treasury doesn't have to issue out, more of these notes. So that's going to bring it down. And when that comes down, mortgages are going to come down, borrowing costs are going to come down, short-term borrowing costs are going to come down, which is good, right? Which is a welcome sign. And, I think that's going to be the rebound that I've been waiting for especially for REITs, especially for the real estate market. I didn't cover too much in real estate today, because I mean, real estate's really boring, but you know, more to come, I guess. More to come. So anyways, guys, I appreciate you guys as always. Please like, subscribe if you haven't already done so. All right. You guys have a great weekend. Have a great rest of your night. And I will see you guys on Monday. And I will see you guys, probably I'll be pumping out a few videos this weekend. So keep your eyes peeled. And I appreciate you guys. You guys have a great